They were a group of whiz kids who seemed too smart to fail. They built a $32 billion crypto empire. They hobnobbed with celebrities and preached saving the world. But they stole $8 billion from customers, and it all imploded in one of the biggest frauds ever. This is the story of Sam Bankman-Fried and FTX, and how brainpower without brakes led to disaster. In less than 4 years, he went from little-known crypto trader to the face of a crypto empire. Then the whole thing collapsed, exposing one of the biggest financial frauds in modern American history. What made FTX so dangerous was not just greed. It was a combination of intelligence, speed, access, hype, and a complete collapse of basic judgment. Welcome to Crooks in Suits, where we take a deep dive into corporate scandals. My name is Ray, I'm a chartered accountant, and I've worked as a chief financial officer across banking and fintech. Sam Bankman-Fried, we'll call him SBF, was born in 1992 in Stanford, California, the son of two Stanford professors. He studied physics at MIT before entering finance. He then started Jane Street Capital, a quantitative trading firm known for taking only the very brightest. Here he developed a reputation for being technically strong and extremely focused on numbers and systems. That background mattered. He's not a random crypto promoter shouting into the void. He understood arbitrage, market structure, trading systems, and how to build a business that looked sophisticated enough to attract serious money. The people around him included Gary Wang, later his FTX co-founder and a former Google engineer, and Caroline Ellison, who became CEO of Alameda Research. She also came from an academic and trading background. Caroline's parents were both economists at MIT. In 2017, SBF left Jane Street to found Alameda Research, which was set up to take advantage of arbitrage opportunities in crypto. Alameda initially focused on cross-exchange Bitcoin arbitrage, targeting price inefficiencies between high-demand Asian markets and cheaper Western exchanges. SBF's algorithms executed at scale, rapidly proving the model's profitability and fueling early growth. His co-founder, Tara McCauley, quickly left, calling SBF dishonest and manipulative, with concerns of risk management and business ethics. Alameda was largely owned by SBF and did not seek external funding. Later, Alameda also provided basic market making, venture capital, and high-frequency trading, based around cryptocurrencies. So what about FTX? FTX was founded in 2019 by SBF and Gary Wang. It was a crypto trading platform. It let users buy or sell coins like Bitcoin or Ethereum and bet on big price moves with tools like futures contracts and high-leverage options. It grew at a terrifying speed. By 2021, it had become one of the biggest crypto exchanges in the world, with its valuation rising to tens of billions in a very short time. In early 2022, FTX was valued at $32 billion. In October 2021, Forbes magazine pegged SBF's net worth at $22 billion, making him the richest under 30 globally. FTX was never listed. Major investors included Binance, with an initial 20% stake which was later sold, Sequoia, Temasek, SoftBank, Tiger Global, and Ontario Teachers Fund. SBF maintained majority control via layered holding companies. Overall, investors have put in $1.8 billion. The growth was powered by aggressive fundraisings and huge trading volumes, some of it with Alameda Research, and relentless marketing. FTX bought sponsorships, celebrity endorsements, and naming rights. Tom Brady, Larry David, and major sports partnerships helped turn the company into a mainstream brand. SBF also cultivated an image as the good crypto billionaire. He dressed casually, talked about giving money away, and presented himself as a thoughtful utilitarian who cared more about effective philanthropy than luxury. That public persona made FTX feel safer than it really was. Effective altruism was a major part of SBF's public identity. The idea is to use evidence and reasons to do the most good possible, and SBF presented himself as someone making money in order to give it away. That philosophy made him attractive to donors, journalists, and policy people, but also gave him a moral shield because he could frame wealth accumulation as a temporary sacrifice for the greater good. The irony is brutal. A movement built around careful reasoning became associated with one of the least careful financial collapses in recent memory. So who were the main players? The main circle was small and tightly linked. SBF ran the whole operation, Gary Wang handled key technical systems, and Caroline Ellison ran Alameda. Gary Wang had met SBF at a high school math camp and later became his MIT roommate for 3 years. Wang's coding genius impressed SBF early. They reconnected in crypto circles, with Wang joining Alameda as lead engineer before co-founding FTX as CTO. SBF met Ellison as a fellow Jane Street trader around 2015-16. She joined Alameda in 2018, despite initial doubts about the culture, and became his on-off girlfriend, and rose to CEO by 2022. Their professional and romantic ties were deeply intertwined. Alameda Research was still owned by SBF, and that relationship became central to the fraud. Ellison was not just a bystander. Prosecutors later said Alameda, run by her, used billions in customer funds, and she testified that customer money had been used to cover debts and make investments. At its peak, FTX was headquartered in the Bahamas, not in the US, and that choice gave it regulatory flexibility and distance from American oversight. There were other offices too, in the US, Hong Kong, London, New York, and San Francisco. They had approximately 300 staff, but mostly they were in the Bahamas. The Bahamas had actively courted digital asset firms, and FTX benefited from being in a jurisdiction that wanted to become a crypto hub. FTX had an extremely weak board of directors who never met, mostly SBF, Gary Wang, and some employees. In essence, they were all controlled by SBF. The external investors were to blame as well. They should have insisted on a stronger board. The public brand was minimalist and almost monastic, but their private lifestyle was very different. SBF lived in luxury in the Bahamas, and reports described a gilded inner circle staying in resort-style conditions, while presenting themselves as serious mission-driven technologists. People later saw a highly visible moral brand fall apart in real time. That contrast is one of the reasons why the story is so fascinating. SBF sold the idea of rational sacrifice while living in a world of private jets, expensive real estate, celebrity access, and enormous status. SBF lived barefoot in cargo shorts, slept 45 hours on a beanbag or inflatable mattress amid office clutter, and played video games like League of Legends during billion-dollar meetings. SBF multitasked constantly, tweeting, trading, and interviewing hires while ignoring hygiene, reportedly going days without a shower. He spent $40 million in 9 months on private jets, Super Bowl ads, Larry David, and also bought a $40 million Bahamas penthouse for his supposedly polyamorous inner circle, which included ex-Caroline Ellison. The inner circle and about 6 other top staff shared this penthouse from 2021 to 2022. SBF demanded 24/7 availability, holding meetings at 3 a.m. while playing video games or trading, and expecting employees to match his 20-hour workdays fueled by Adderall and little sleep. So what is the actual fraud? The actual fraud was simple at its core, although the structure around it was sophisticated. In a nutshell, FTX client money was misused. FTX held client money on behalf of their clients. For example, FTX could not sell your Bitcoin unless they already held onto it. And it was convenient for clients to leave cash and crypto with FTX so they could trade instantly. Alameda had a secret coded backdoor into FTX to access client money right from the beginning. Prosecutors said SBF directed co-conspirators to alter FTX computer code so Alameda could withdraw effectively unlimited amounts of crypto. What precipitated the discovery of the fraud was massive losses from Alameda. Despite Ellison being nominally in charge of Alameda, SBF still dictated investment strategy. He was, after all, the owner. Crypto prices crashed hard in 2022. Alameda had been expecting prices to keep rising. When Bitcoin dropped 70% and other coins tanked, their positions blew up. To make it worse, Alameda had also borrowed money to increase the size of their positions, resulting in even bigger losses. In total, this amounts to $5 billion. These losses meant Alameda could not cover their trading desks or margin calls. They needed liquidity immediately, or they would be forced into liquidation. And this forced Alameda to use FTX client funds. They ended up stealing $8 billion. That money was used to cover Alameda's losses, support risky trading, and provide the appearance of solvency. Another part of the fraud was the use of FTT tokens to support the fraud. These were FTX-issued tokens with no intrinsic value and used as fake collateral to cover borrowings from client money. Some external lenders even accepted FTT as collateral. As of today, they are worthless. So how did it all unravel? The unraveling was very sudden. On the 2nd of November 22, CoinDesk, a crypto news platform, received a copy of Alameda's balance sheet anonymously. To this day, nobody knows who did it. It did not reflect any losses. Instead, it showed 90% of the assets in FTT. A few days later, Binance, one of their investors, but also a competitor, announced they were dumping their FTT holdings. FTX customers, sensing the issue, started to panic and asked for the client money to be returned. SBF had no choice but to halt withdrawals, and the Bahamas immediately ordered an asset freeze. FTX and Alameda filed for Chapter 11 bankruptcy on the 11th of November 2022. SBF was arrested, extradited from the Bahamas, and taken through a federal fraud trial in New York. Key insiders, including Caroline Ellison and Gary Wang, cooperated with prosecutors, and their testimony helped show how customer money moved through the system. SBF was convicted on fraud and conspiracy charges in 2023. In March 24, he was sentenced to 25 years at Club Fed and ordered to forfeit more than $11 billion. Not that he had that sort of money anymore. The sentence reflected the scale of the fraud and the fact that the court saw this as an intentional, high-impact deception rather than a mere collapse caused by market conditions. Ellison got 2 years in jail and ended up serving 11 months. Wang managed to escape jail. So who lost money? The biggest victims were FTX customers who were left unable to access their funds after the collapse. FTX also harmed investors and lenders. Prosecutors said the scheme defrauded investors of more than $1.7 billion and lenders to Alameda of more than $1.3 billion. Interestingly, the creditors were eventually fully paid through the liquidation process. This was done through asset sales. They also had a VC stake in Anthropic, the AI company, and this was sold for $1.4 billion. And there were further recoveries through lawsuits and clawbacks. The auditors also suffered massive fallout. Prague and Metis lacked crypto expertise and rushed into auditing FTX without assessing their own competency and ignoring the massive related party risk with Alameda Research. They failed basic procedures like verifying customer deposit reconciliations or probing Alameda's unlimited credit line, issuing clean audit opinions despite no evidence, leading to an SEC fine in 2024. John Ray III, the FTX bankruptcy administrator, called it unprecedented chaos, a complete failure of corporate controls, and worse than Enron. He had never seen such an absence of trustworthy financial information. There were no records, auto-delete messages, group email for private keys. His take, it was an old-fashioned embezzlement by inexperienced kids, not a sophisticated fraud. Cash was scattered globally with no control. Interestingly, SBF has been aggressively seeking a Trump pardon since early 2025 via proxy X posts and his parents lobbying ex-Trump lawyers. SBF's parents, Joseph Bankman, a tax law professor, and Barbara Fried, ironically an ethics professor, had advisory roles at FTX and Alameda. Reports described them as benefiting from company money and being close enough to the business to raise questions about what they knew and when they knew it. SBF bought them a $16 million house in the Bahamas. This property remains in limbo. SBF and his team were intelligent and technically competent. The bigger problem was a mix of arrogance, groupthink, moral vanity, and the belief that being smart meant being above ordinary rules. And that's what makes this case so disturbing. FTX was not only a financial fraud, it was a story about status, ideology, lack of common sense, and how easy it is for polished public mission to hide a rotten private reality. I hope you enjoyed this episode of Crooks in Suits. Please leave a like and remember to subscribe as it helps the channel.